Hello investors and future investors, welcome to the channel. In today's video, I'm going to show you an option strategy that can be used if you're trading with a small account. So if you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. And yes, you too can make money from your living room with option trading, and I will show you how. And all I request in return for this free content is an early thumbs up by you hitting the like and subscribe button. Now while you're down there, also consider subscribing for more ways to win with options. Now before we get into this video, I would like to announce our free giveaway. So as you guys have been seeing on my previous videos, we will be having a giveaway at 600 subscribers. We're very close now. Now the prize for the 600 subscriber, whoever wins is gonna have their Robinhood referral link posted under my next video, and that's gonna be there for eternity. Now all you have to do to win is subscribe. That's it. It's that simple. Welcome to Investment Gains. Let's jump right into it. So today's video is going to be based on the call credit spread. I'm going to give you information on why would you want to use this option strategy. I'm also going to give you info on when is a good time to use spreads, and most importantly, the cost of the spread, meaning the cost to get into the spread. Now, for today's video, I'm going to use one of my favorite ETF, which is going to be the Spider ETF or SPY. Now, I like trading the SPY ETF for a couple of reasons. The number one reason is that it has multiple trading days per week. And the number two reason is that spreads are a lot easier to be filled because SPY has such huge volume. Now, if you don't know what volume is, I'm going to link a video to the Greeks that explains the volume. So, why do you want to use the call credit spread? Well, the call credit spread is perfect for people trading with small accounts. Let's say you have an account of like $1,000 or below, then a call credit spread is a good option strategy to help you grow this account. Now we're going to go ahead and we're going to get into our spread. So trade SPY options. Now with all other options, we need to select our strategy, whether we're buying or selling, whether it's going to be a call or put, and also our strike date. Now for the call credit spread to be extremely effective, it's better to choose your strike price above the current share price. Now we're going to start off this by using a sell call. Now the reason why I'm going to start off with a sell call instead of a buy call is because with the buy call, it doesn't give you the chance of profitability. Now that I switch over to the sell call, you can see it right here. You do get a chance of profitability. So that's why I usually like to start off with the sell call. So now we're going to choose our expiration date, and I'm going to go out to next Friday. Okay, so remember, this is just an example. So for purposes of this video, we're going to use the 453 strike price, and for that, it gives us a 70% chance of profitability. Now we're going to receive 1.98. Now the reason why we're going to receive 1.98 or $198, as you know, each option contract is multiplied by 100 shares. And the reason is because we're selling something. Whenever you sell something, you receive something in return. And that is going to be the total credit of 1.98. Now, the call credit spread is 2 legs. Now we're going to go ahead to the second leg, which is going to involve buying the other call. Now, for our buy call, we're going to select the strike price of 454, which is directly above our sell price. Now, for that, we're going to have to pay something because we're buying it. Now, we're going to have to pay 1.51 or $151. Now, the difference between 151 and 198 is going to be 47, and this is going to be the minimum credit you're going to receive. Now, I'm going to get back to the minimum credit in a second. Now, this is called a spread. The reason why it's called a spread is because of the distance between your strike prices. The distance between 453 and 454 is going to be $1. And like I said earlier, each option contract is multiplied by 100 shares, which would make it $100. So the cost of this spread right here is going to be $100. Now, how do you know that you're doing this strategy correctly? Well, first of all, it says call credit spread right here. If you do this strategy and it does not say call credit spread, then I highly recommend that you replay this video. Now, when you do the call credit spread, right away you're going to receive a minimum credit into your buying power. Now, that minimum credit is yours to keep no matter how this trade goes. Now, we're going to hit continue, and then I'm going to tell you how do you win the trade and how do you lose the trade. So we're going to go ahead, we're going to select the amount of contract we want, which is 1. We're going to hit review, and you're going to get the summary of the spread. So now you have the summary. So right away, once you do a call credit spread, you're going to receive a minimum credit. That minimum credit is yours to keep no matter how the trade goes. In order for you to do the spread, you're going to need to leave collateral. Your collateral is going to be $100 in this occasion, and your collateral is going to be the distance between the spread. Now, in the bottom, the order summary tells you what you did in order to open this spread. So you sold at 453 and you bought at 454. So how do you win with a spread? Well, if on September 10th, SPY is trading at your sell call, which is going to be 453, then you get to keep your minimum credit and you get your collateral released back to you. And now you're able to do a spread again for the following week. So how do you lose with this trade? Well, once again, if on September 10th, SPY is trading at 454 or higher, then you get to keep your minimum credit once again, but now you have lost your collateral. But it's not so bad because all you lost is $53. Now the $53 comes from the $100 you left for collateral minus your $47 minimum credit, so all you lost is $53. Now, if on September 10th, SPY comes between 453 and 454, you're gonna get your minimum credit once again. Like I said, that is yours to keep no matter what, but then you get part of your collateral back. Now, I know this all sounds a bit confusing, but do not worry. I'm going to do an example. I'm doing it right through, so I show you how simple this is to do. Now, for this example, we're going to choose another stock. We're going to use Amazon this time, ticker AMZN. Okay, so we're going to go to Trade Amazon Options, and we want to start off with our sell call. Let's make sure it says sell and call. We're going to choose our strike date 1 week out, which is going to be September 10th. We're going to choose our strike price of $34.90, and then we're going to go over now to buy and call, and we're going to choose the strike price right above it at $34.95. We're going to hit continue. We're going to choose the amount of contract, which is 1. We're going to hit review order, and now it's asking you if you want a debit or a credit. Always say credit because we're doing a call credit spread. Now right away it shows you here your minimum credit is going to be $203 and the collateral is going to be $500. The collateral on Amazon is going to be way higher than the collateral on SPY. Now, we have lots more strategies like this on this channel. So if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell to get an alert whenever I post a video. But most importantly, share this video with someone you think that can benefit from its content. Let's help as many as we can. Thanks for watching, and always remember, keep pushing your investments.